Okay, it is Friday morning, January 30th, 2026. And if you've checked your portfolio in the last few hours,
Oof.
yeah, you're probably feeling a distinct lack of that, up-only euphoria we had back in December. The market woke up today and just chose violence.
Violence is pretty violent. The screens are completely red. We're watching Bitcoin just violently decouple from the bullish thesis that, everyone was so confident about just 48 hours ago.
It's the breakdown that hurts the most. For weeks, we've been tracking that $88,000 to $90,000 range. We called it the fortress. It was supposed to be the accumulation zone where all the ETFs were, loading up.
It's the buy zone until yesterday.
And when a fortress falls, it gets ugly fast.
Yeah.
We saw a capitulation, a drop all the way down to an intraday low of $81,058.
It's a massive structural break.
It is. But looking through the sources this morning, you're suggesting this isn't just like standard volatility. We're not just seeing a price drop.
No. We are seeing a structural failure in the market plumbing. We are currently sitting in what I call a liquidity air pocket.
That sounds terrifying.
It feels terrifying if you're long. Essentially, the market has just run out of oxygen. It's a perfect storm of three distinct forces all colliding at the same time.
Okay, what are they?
You've got a massive institutional exodus from the ETFs. You've got this government shutdown trap that is springing shut tonight, and a Federal Reserve that is basically decided to stand back and watch it burn.
The trifecta of bad news. But, and I want to flag this right at the top because it's so easy to miss in the panic.
Right.
There's a massive structural bull case forming in the background that nobody is talking about because they're too busy staring at the crash.
You mean Project Crypto?
Project Crypto and the whole regulatory shift.
Right.
So here's the plan. We're going to unpack the forensics of this crash first, why the floor just fell out. Then we have to get into the weeds of this shutdown trap because the mechanics are bizarre. But stick around because the regulatory news from yesterday is arguably more important for where we are 6 months from now.
I completely agree. The price is noise. The regulation is the signal. But yeah, we have to deal with the noise first.
Okay, let's do the forensics. That $88,000 level. We've seen passive bids just sitting there for weeks, corporate treasuries, smaller ETFs.
They were all parked there.
So why did it turn from a floor into a ceiling so fast?
It's a classic liquidity cascade. Think about it. Everyone was positioned for breakout to 95,000. The market was leaning so far forward.
Everyone was on the same side of the boat.
Exactly. So when we dipped below 88K, those passive bids didn't just get filled, they got completely overwhelmed.
And once you chew through that bid wall, that's where you hit the stop losses.
Precisely. And in crypto, when you fall through the floor, you hit the leverage. We witnessed a long squeeze of historic magnitude. Depending on which data you look at, we saw between $1.1 and $1.7 billion in crypto liquidations.
It's in 24 hours.
It's in 24 hours.
Nearly $2 billion just vaporized. And looking at the breakdown, something like 93% of that was long positions.
That's the definition of a lopsided market. That 93% figure tells you the market was effectively all in. There was no cash on the sidelines to catch the knife.
So this wasn't just people deciding to sell.
No, this was forced selling. Margin calls triggering market sells, which pushes the price down, which triggers more margin calls. A domino effect.
I want to zoom in on the bottom of that move. That wick down to 81,058. It happened during the late New York session yesterday. Usually when we hit a level like that, we see a V-shaped recovery, right? The whales step in, they buy the dip, and we bounce hard.
That's the problem. We didn't see that.
It felt sluggish.
Anemic is the word. The bounce was low volume. It was probably just automated bots covering their shorts. This is a massive red flag.
Why?
It tells us that the large-scale whales, the entities that actually move the market, did not look at $82,000 and think, this is a bargain.
They think it's still expensive.
Or they're waiting for lower levels. If 81K doesn't hold, and the technicals look pretty shaky, the next major support isn't until the $74,000 to $78,000 range.
That's what some analysts are calling Goblin Town.
It is. 74,000, it aligns with market structure floors from back in Q3 of 2025. It's a logical place for bids to show up, but it's a long way down from here.
And on the flip side, that old $88,000 level.
$88,686 to be specific. That's now the iron ceiling.
That's the new resistance.
We have to reclaim that to even begin talking about a recovery. But, as you said in the intro, charts don't crash in a vacuum. This liquidity air pocket didn't just appear. It was kind of engineered by Washington.
Okay, we have to talk about the shutdown. It's Friday the 30th. The U.S. government runs out of money at midnight. We've seen shutdowns before. Usually the market just shrugs them off. Why is this one different? Why is it draining liquidity?
Because markets hate uncertainty, and this shutdown is colliding with a really fragile economic moment. But more importantly, the political catalyst here is incredibly toxic.
This all goes back to that incident in Minneapolis on January 24th.
Right. And we need to be precise here because the details really matter for the market reaction. The legislative deadlock in the Senate is entirely tied to the death of Alex Pretti.
The 37-year-old VA nurse.
Correct, who was shot by federal agents.
And the initial story from the Department of Homeland Security.
The initial DHS narrative was that Pretti was brandishing a firearm. That was the official line for about 48 hours.
Until the video surfaced.
Correct. Witness testimony and video came out that, explicitly contradicted the DHS claim. It appeared he was unarmed. And this obviously caused a massive public outcry, but financially it just toxicified the whole appropriations process.
So Senate Democrats drew a line in the sand.
They did. Chuck Schumer and the Senate leadership, they refused to vote for any spending package that included DHS funding without immediate major reforms to ICE and CBP.
Things like mandatory body cams, warrant requirements.
All of it. So the budget bill wasn't just about money anymore. It became this huge referendum on policing reform.
And that stalled everything.
Stalled everything until late last night, January 29th. They finally struck a deal they're calling the severance strategy.
Which is actually a pretty clever legislative move. They agreed to just sever the DHS funding from the rest of the government.
Yeah, pass the normal budget for defense, labor, all that stuff, and then do a short-term patch for DHS to let things cool down.
It's a viable path. The Senate can vote on that today.
Yeah.
But here's the trap. Here's why the market is dumping. The House of Representatives isn't in D.C.
They literally aren't there. The House is in recess until Monday, February 2nd. And Speaker Mike Johnson has said he will not recall them for an emergency vote this weekend.
That's absurd. So even though a deal exists on paper,
it cannot be ratified before the midnight deadline. A technical shutdown is structurally inevitable over the weekend.
Which guarantees operational friction. Customs, TSA, regulatory bodies, everything goes into this limbo state.
And markets look at that gap from Friday to Monday, and they just see risk. They see a weekend where nobody's at the wheel that drains liquidity. Traders pull their bids.
Normally, this is where the Fed steps in, the Powell put to calm everyone down. But he's taking a different approach this time.
Yeah, we're calling it the Shutdown Neutrality doctrine. In his press conference on the 28th, Chair Powell was explicit. He said the Fed will not preemptively liquefy markets to offset the shutdown.
So no repo market injections, no surprise rate cuts.
Nothing. He's basically telling the politicians to clean up their own mess. But there's a secondary risk here that I think is even scarier for the algorithms that trade this market.
Okay.
Powell noted that a shutdown stops the collection of federal economic data.
Oh, right. The Bureau of Labor Statistics, the Census Bureau, they all go home.
Exactly. No CPI collection, no non-farm payrolls data. The Fed is effectively flying blind into the next meeting.
That's a great way to put it. It's like you're trying to land a 747 in a storm and suddenly your instrument panel just goes black.
That's what we call epistemic risk. The risk of not knowing what's true. If the Fed doesn't know what inflation is doing because the data collectors are furloughed, how do they set interest rates?
They can't.
And when traders realize the pilot is flying blind and there's no safety net, they reprice risk immediately.
And that repricing is what we are seeing in the ETF flows. We have to talk about this diamond hands myth. We've been told for 2 years that institutions never sell, that they have a 10-year horizon.
Well, looking at the flows from the last 9 days, that myth is officially busted. We've seen over $2 billion in net outflows from the Spot Bitcoin ETFs.
$2 billion! That is a staggering amount of capital leaving the system.
It is. And the smoking gun was yesterday, January 29th. The iShares Bitcoin Trust IBIT.
BlackRock.
This is BlackRock. This is supposed to be the smart money proxy, the stickiest capital in the world. They saw over $317 million in outflows.
In a single day.
In one day.
So even BlackRock's clients are folding. But why? Is it because they suddenly hate Bitcoin?
I don't think they hate Bitcoin. I think they hate uncertainty. This is a broad-based de-risking. Institutional investors, they see the shutdown, they see the lack of a Fed backstop, and they see the volatility.
And they're rotating out.
They're rotating out of crypto and into gold or cash just to weather the storm. It's defensive. They're going to cash, waiting for the smoke to clear.
But when billions of dollars move to the sidelines at the same time...
The price crashes. It's just mechanical.
Okay, so we have a broken chart, a technical government shutdown, a Fed that's flying blind, and institutions fleeing to cash. If we ended the deep dive here, I think our listeners would be spiraling.
It's a pretty grim picture.
But you promised a twist. You said there is a structural bull case that formed yesterday right in the middle of all this wreckage.
There is. And arguably, for anyone with a time horizon longer than a weekend, this is the only thing that really matters. While everyone was watching the red candles, the U.S. government quietly launched Project Crypto.
This refers to that summit between the SEC and the CFTC.
Exactly. Yesterday, SEC Chair Paul Atkins and the newly confirmed CFTC Chair Michael Selig held a joint summit. And for the first time, in the history of this industry, the two major U.S. regulators were singing from the same song sheet.
Which is a miracle in itself.
It is. They announced a unified taxonomy. They are finally going to clearly define, in a joint framework, what makes a digital asset a security and what makes it a digital commodity.
Okay, well, let's make this real for someone listening. Why does a taxonomy matter?
Well, think about a token like Solana or Cardano. For years, they've lived in this gray area. The SEC says it's a security. The foundation says it's a commodity.
Which means they can't get listed on traditional exchanges, banks can't really touch them.
And they're constantly worried about getting sued. Regulation by enforcement. This unified taxonomy ends that. It creates a checklist. If you meet criteria A, B, and C, boom, you're a commodity. You're regulated by the CFTC, and you can trade like
soybeans or gold.
Exactly. It opens the floodgates for institutional products on altcoins, not just Bitcoin.
That is huge. And it wasn't just the taxonomy. I saw something about prediction markets, too. Platforms like Polymarket and Kalshi.
That was the other big win. The CFTC formally withdrew its proposal to ban event contracts on political and sports outcomes. Chair Selig signaled they're moving toward lawful innovation.
So betting on the election or the Super Bowl on the blockchain is going to be fully legal and regulated?
That is the signal. It validates that entire sector of information markets. And it wasn't just the agencies. The Senate Agriculture Committee voted yesterday to advance the Digital Commodity Intermediaries Act.
The vote count was interesting there, too?
12 to 11. Tight, but it passed.
Okay.
And this act moves toward treating Bitcoin and Ethereum definitively as commodities under the CFTC's jurisdiction.
And the industry has always preferred the CFTC. They're seen as the more practical regulator.
Practical and market-focused, yeah. This removes what we call regulatory tail risk. The U.S. is signaling very clearly that it wants to be the crypto capital. They want to stop the offshoring of innovation.
Okay, so help me reconcile this for everyone listening. We have this strange dichotomy. On one hand, the market is in what you call defensive capitulation.
Yes. Price is collapsing because of short-term liquidity mechanics.
We've got a liquidity trap, a government shutdown, a price that might test $74,000. But on the other hand, the infrastructure is maturing faster than ever.
That is the paradox. The easy money of late 2025, the meme coin mania, the speculative frenzy, that is gone. It's being washed out. But it's being replaced by a professional, regulated market structure.
So we're transitioning from a casino to a proper stock exchange.
And that transition is painful. Casinos are fun. Stock exchanges can be boring and efficient. But the amount of capital that can enter a regulated, efficient market is, 100 times larger than the capital that plays in the casino.
So if you're a listener sitting on your hands today watching the portfolio drop,
you need to realize that the drop is mechanical. It's the shutdown. It's the ETF flows. But the foundation being poured yesterday with Project Crypto is what supports the next all-time high.
It's the difference between weather and climate. The weather is a hurricane, but the climate is getting warmer.
That is a perfect way to put it.
Before we wrap up, I want to leave everyone with a final thought that really highlights the tension we just discussed. We've spent this whole deep dive talking about how the market is dumping because of government dysfunction.
Right.
The shutdown, the failure to pass a budget, the Alex Pretti fallout. Government incompetence is the bear case.
It is, yeah.
And yet, the massive bull case for the future relies entirely on government competence, on Project Crypto, on the SEC and CFTC working together, on new regulations being implemented correctly.
It's deeply ironic.
It just makes you wonder, can this asset class, which started as rebel money,
cyberpunk money, yeah,
that didn't need the government, can it survive the transition to becoming a regulated commodity without losing its soul?
That is the trillion-dollar question. If we regulate it to safety, Do we regulate away the very thing that made it valuable in the first place?
Something to mull over while you try not to check the charts this weekend. Stay safe out there, everyone.
See you on the other side.